Hi, everybody. Welcome to the April 2026 Economic and Market Update presented by Commonwealth Financial Network. My name is Chris Fasciano, and I am Commonwealth's Chief Market Strategist. March served as a reminder that market risk can materialize at any moment and lead to short-term turbulence. The main story throughout the course of the month was the ongoing war with Iran. From an investment perspective, the war manifested itself in surging oil prices, which rose over 50%. This led to concerns about accelerating inflation and caused several bouts of stock market volatility. As a result, March was a challenging month for stocks, as markets pulled back due to the rising geopolitical risk in the Middle East. The S&P 500, Dow Jones Industrial Average, and Nasdaq all fell during the month by around 5%. International markets fared worse due to concerns around a greater economic impact overseas from the war, closing down over 10% in March. Bonds were also down for the month due to rising interest rates. The 10-year Treasury yield rose from 3.95% at the end of February to 4.3% by the end of March. Short-term rates rose as well during the month as traders tempered their expectations for Federal Reserve interest rate cuts in 2026 due to the impact of rising energy prices on inflation. While headline results were disappointing for U.S. stocks and bonds, the fundamentals continue to show signs of impressive resilience. S&P 500 earnings growth came in well above expectations in the fourth quarter at over 13%. More encouragingly, analysts expect to see further growth ahead, and full-year 2026 estimates have actually increased during the month of March despite the headlines. Over the long run, fundamentals drive performance, so the strong earnings growth from corporate America is a good sign for investors. In addition to the geopolitical risk in the Middle East, investors also face risks domestically. Employment growth continued to show signs of weakness to start the year, with February showing a decline of 92,000 jobs. Inflation also remained stubbornly high, and this was all occurring before the impact of higher fuel prices makes its way through the economy. Taken as a whole, we have a lot to keep in mind. As we have just seen, headlines can still drive short-term market moves, and more volatility is certainly possible. Diversified portfolios should be prepared to weather any potential impacts on markets if that happens. While the month ended with headlines about a potential negotiated end to the war, military action does continue. The situation certainly needs to be monitored in the weeks and months ahead to understand the full impact of higher prices on the global economy, which could drive further uncertainty. But despite the potential risks, the market fundamentals remain supportive. And while the jobs market has shown some signs of weakness, the economy continues to grow and remains on reasonably solid footing as we head into the second quarter. Therefore, we should be in a relatively good position to weather headwinds from higher oil prices. This would mean that the most likely path forward is for continued growth and long-term market appreciation. That's it for this month's update. I'll be back next month to walk through whatever the markets throw our way. Take care, and thanks as always for watching.